Alright, so welcome back, guys. So today we are going to be looking at the Nasdaq E-mini futures. So in front of you having the daily time frame of the December contract of the Nasdaq E-mini futures Nasdaq. So as you all remember, on Friday we had a market that dropped significantly as responding to a tweet that Trump said, failing to contribute to the Chinese stuff, blah blah and shit. But that led us into this big drop on Friday, right there, coming into this candles low. And if you are to look closely, we have a fair value gap right there from this candles high. We're going to consider this low. Market drops to the low of that fair value gap on the daily time frame, and then we open up on Monday, leaving a large new weekly opening gap right there. The market refers to that one more time, just like that, taking out Monday's low. We didn't have a week on the Monday's daily candle, so the Tuesday's trading had to come and clear those equal lows right there. So we come drop into the new weekly opening gap, and then the market is pushed back right higher, trading into this fair value gap that formed on the daily between Thursday going into Friday and Monday's trading. We form a fair value gap right there, and I'm so conscious about Tuesday's low because it was last week's low of the week. If you do not consider this manipulation that formed on Friday, this Tuesday's low is so significant. And onto that, if you look back, we have a fair value gap right there. So this fair value gap was inversed. We have Tuesday the 30th of September 2025 going into Wednesday the 1st of October and Thursday the 2nd. So these three candles have a fair value gap that was filled and inversed by this Friday's candles. The market is referring into that. I want you to note, to have your eyes onto that. So if I'm to add some lipstick, make my chart clogged for a minute, I'm going to show you what I'm looking at. This is the opening range. I'm going to pull that off. We have Tuesday's low marked this black line, the black dashed line. Then we have this daily fair value gap, the high and the low annotated by these blue lines. Then I'm having its quadrants as dotted lines. Then I'm having this that I talked about, the fair value gap. I'm considering this low and this high. Market drops and trades into the low of that, and I'm having this week. Remember, weeks are considered as gaps. We treat them as gaps. So I'm having the market respecting the upper quadrant of this week, and this week is also in the new weekly opening range gap. So if we are to drop on the lower time frame, probably the 1 minute, we are going to see this clearly. So if we are to drop on the 1 minute, into the 1 minute, I want you to note those references in price. Take this off, take everything off. So here you have your, if I'm to take, this is where Friday traded to. Remember the low on the daily time frame where the Friday's candle ended right there. This is the low of the other fair value gap. So if I'm to put that off, I think I won't need that. I'm to take that off just like that, remaining with this daily week that is inside the new weekly opening gap. So I'm not considering the whole new weekly opening gap because I'm having something that can pull my eyes towards it inside of the new weekly opening gap, and that gives you a working window for you to reduce on the range you are working with. So I'm reducing my weekly range from the new weekly opening gap, dropping into the week on the daily time frame. Hope you can understand that. If I'm to zoom out like this, we had Monday's trading. Remember, Monday forms this fair value gap right there. So Monday, the PM will rally higher. Remember, it is a Monday, so I'm expecting the Monday to consolidate. And mind you, this was a no-news Monday, so we had no news. We had a bank holiday on Monday. So I didn't expect the market to move that much. I have the market accumulating, and if this low stays protected, I expect the market to stay. Let me see. If I'm to mark out this candle right there, the open of this candle to give me the Sunday's open, this is a bullish candle right there. If I'm to mark this to give me the Sunday's open, I need it to the tick. To give me the Sunday's open. If I'm to make this purple, to give me the Sunday's open. So if I'm to look for the low of the week, this current week, that's why I'm telling that I'm expecting bullishness. If I'm to expect this week to continue higher, I expect the market to manipulate below the Sunday's open, then come back out again, and then rally higher. So Monday opens up, as you can see, there is no market does not cover any of that range. We just stay into that, then we rally higher. Remember, Monday forms the daily fair value gap that I have told you. Between Thursday, Friday, and Monday, we form that fair value gap on the daily. So referring to Tuesday's low, I have it marked here in the PM session. We happen to trade into that Tuesday's low, and the market refers to it as a significant level. So we have Tuesday's low. We first failed to break above it. We break above it, market rallies higher, then we drop into that, manipulate, give it a mohawk, market works with it, then we drop lower, we use that one more time, and then we drop coming into Tuesday. So this is the opening range on Tuesday, 12 a.m. to 12:30 opening range. Okay, so now we are going to the trading for Tuesday. Tuesday's trading, as you can all see, the market is in a bearish trend. So this is bearish, and when do I expect this market to reverse? Probably in the London session. If not the London session, if the London session doesn't give me my reversal, then I'm waiting for the 10 a.m. candle to give me a new sort of a daily profile where I will follow the accumulation, manipulation, and distribution. I'm going to follow the AMD. So now going into 7 a.m. trading, right there, let me mark 8 a.m. 8 a.m. right there, and the 9:30 opening bell. Okay, so I'm going to zoom in into that. Note that our opening range on 12:30 is above price right now, so we are currently working below a large draw on liquidity. So going into 7 a.m., we have the market leaving obvious lows. We have two relatively equal lows right here. This is sell side. If I want to mark this out as sell side liquidity, this is large draw on liquidity, which is sell side liquidity. I mark that as right. Sorry. This is that is sell side liquidity right there. Now 7 a.m. opens up as the market started rallying for higher prices, looking forward for these equal lows right there coming into this. But I do not need this, I do not need that, knowing that we went below the Sunday's open. This purple line is the Sunday's open. We refer to that, then we drop lower. I can use this as my execution, and on that, for me to look for buys, I can use that as a reference level that the market has managed to come back above Sunday's open, so I can expect this to continue higher. I'm having this as my breaker right there, so measuring from this low to that high, give me the optimal trade entry. From that low to that high, if I'm to measure the optimal trade entry right there, you will refer to the market closing above this. We fail to come back into that, so optimal trade entry doesn't give you a clear entry right there, and I'm fine with that. I'm expecting, if the market happens to go above where I expect the breaker, I'll execute at that if I miss this. Okay, now that's how to counter that optimal trade entry. So I'm having a bullish order block right there, just at that. Extend that into price, you're going to need that later. Bullish breaker right there. Now in this bullish breaker, we also have a bullish fair value gap right there. These are executions 101. So this is a fair value gap that is formed. Now this is a silver bullet of 7 a.m. having a bullish fair value gap right there. From a bullish fair value gap, we have a breaker into that. I want to see the market stay in the upper half of this fair value gap. We do that right there. We fail to touch the breaker, sign of bullishness, then we rally higher. So I'm expecting this to be inversed, rallying into my first profit scaling, going into this high and this high is right there. How far above this size, because this is the obvious draw on liquidity. This is jagged and I'm having a breaker right there. There is no fault in me calling this a breaker because we have a drop, a high, and then a lower low. So there is no fault in me calling this a breaker. But how far can the market go above these highs? Where do we start to run for them? At the 7 a.m. open right there. The run starts at this fair value gap right there. I'm going to hit that. The run starts. So the market is done formulating. The market is done formulating models, accumulation and stuff. So we are now running. So where does the run start from? The run starts from that fair value gap and the breaker. You have the negative 0.5. So that's how far the market can go above this. And for the range that I expect the market to move, I have to measure that. If I'm to measure onto that, I'm going to have quads just like that. Can make this dotted line. Okay, put that off right there. So these are the reference levels I'm having. So from this breaker, I expect the market to run into those highs. So this is buy side liquidity right there. From those highs, I expect the market to run into this, going into negative 0.5. So this is the range I expect the market to move. Now we rally into the lower quadrant of that expected move. we fail to break it, then we drop lower. The moment we close above that, it is used as support. Same to the half of the range, the constraint engagement. We break above that, going into the 0.25. The market just continues falling higher. So here I'm having a bullish order block right there. The market works in the upper half of that, so I'm having a bullish fair value gap right there also. Having a bullish fair value gap. So I have no problem in this session to have the market leaving me obvious draws on liquidity, because I'm working and I'm formulating a model as in accordance to the 9:30 opening bell. Having another bullish fair value gap, the market works in the upper half of that. This shows bullishness. Now we continue targeting into this buy side. That buy side is taken out, then the market rallies back lower, coming into this propulsion block. Now this is a propulsion block. I'm going to mark that as a bullish order block right there. Okay, it works in that, stays within that week. If I'm to mark for you just what the market did in here, we failed to reach half of that week. We work in the upper quadrant of that upper quadrant, then the market rallies high into negative 0.25. After that, the market falls lower. After it moves the specified range, the market drops lower. So coming into 8 a.m. gives me a model for price to reverse. Now 8 a.m. opens up, we have a big drop coming and closing below 0.25. Now if I am to draw from that high to my wannabe breaker right there, mark the optimal trade entry just like that. So before we reach our target, I do not expect the market to take out this high. If we are to use these levels for to push price lower, the market drops, comes back into this 0.25. We close below that, the market comes back into that after 8 a.m. opens up, then we drop, coming back into this towards price. As you can see, if you extend that into price further, I'm going to extend that one. So have the market dropping into that, rallying back into these levels, respecting that again, and then we drop into what? This bullish breaker right there. So a bullish breaker, this bullish breaker, if I'm to edit a little bit of this, I'm going to put that off. Let me leave just that. I need only these levels. So the market drops into this bullish breaker, so I'm having this high for the market structure shift just like that. I was watching a live of some guy, I don't know how to pronounce his name. His name is like this. I wish you can tag him and he sees this video, because he does what I love. I love his trading. So his name is like, oh my god, something of this sort. Calls himself the most disciplined trader on YouTube. So I like him. I like the way he trades. I saw he took this trade but didn't manage to. If he had these levels right here, he would know that these levels would have acted as a target for the market to give me a reversal at 9:30, but I see he made a comeback of that. That is beautiful. So the market drops, coming into this bullish breaker. We have a fair value gap at that. Market drops into, I'm having, this fair value gap, the inversion fair value gap of this within this breaker. So, but for that fair value gap, I'm having the volume imbalance right there. So So I'm watching that. This is open inside this breaker. The market drops into that, then we rally higher. We have a structure shift right here. Have a structure shift at that. Just like that. That's a structure shift. When the market comes above that, and the moment the market comes back, we inverse this. Remember, we have this bullish fair value gap turns into, actually this is a reclaimed fair value gap, because this roll has been reclaimed again. The market comes into that to push price higher. So targeting for these highs would be risky. You would want to take off at these levels, or take partials at this, leaving a runner. So the market comes into that, then we drop. So 9:30 comes when we are dropping. So where do I expect the market to form a breaker for me? This. Do you understand that? So I'm already having levels for my 9:30 trading, and extend that into price. Let me take this off. I don't want my chart to be clogged. This thing. 9:30 opens up. We'll have this move that would have given me the breaker. We are dropping already. Then we rally. This reaches that. Then we push higher. This is 9:28. And then 9:29 rallies into the 0.79 level, trade entry. Then 9:30 opens up into the 0.618. So we form a swing higher. So this is an intermediate term high, short term high, short term high. Then the market forms a swing, and when 9:30 opens up, we drop lower. So this would have been your entry here, 9:30. When 9:30 opens up and taps that again, just like that, targeting what? We have sell side in the precession, and this sell side happens to take us back below Sunday's open. So a move that comes back above Sunday's open, I'm expecting that to have formed the low of the week. So if I'm to having Sunday's open right there, this dotted line, the market drops coming into this sell side. How far below this sell side can the market manipulate? If I'm to have where that move started from, take this off. If I'm to have where that move started from, 9:30 candle going into sell side, the 0.25, and between this negative 0.25 and this upper quadrant of this daily wick, remember we are trading into the daily wick right here, which has the new weekly opening up in it. So we drop into that, and if you can really see right here, we have half of this range between the negative 0.25 and the upper quadrant. I expect the market to give me a bit of price action right at that. So if I'm to measure half of this range from that to that, moving it quite get dotted. Now if I'm to zoom in, just like that, so we have the negative 0.25, which would have been your target, but with the negative 0.25 we have the 0.75, which is the upper quadrant of the daily wick of the week on the daily time frame. So the market fails to drop into the 0.25, we are still continuing rally back higher into this. Now this market trading into this fair value gap before taking out that this draw on liquidity already gives you an entry if you are to go on the opposite direction. So I'm having this as a bearish fair value gap right there, but after 9:30 I'm having a fair value gap, which is the first presentation fair value gap right there on the 9:32, 9:33 and 9:34 candle, having a volume imbalance. You have to take that with you right there. So first presentation fair value gap, extend that into price. Have to take a screenshot of this before my chart gets clogged. Now these are the type of things you take into your book. So okay, so the market manages to drop into the 0.75 level, rally back above into the 0.75 level of this range between the negative 0.25 and the 0.75 level. So if I'm to put this off and we are to use the high that would have formed the breaker and this low, I would have something of this sort. I'm looking for entry, optimal trade entry right there. Control Z. Just like that. So the market rallies and manages to close back above these levels, having ready closures. Then the market drops. Now this is your counter entry for buys going into sell. Now this is the low risk buy we are talking about. And below this, remember, I'm having a large draw on liquidity, which is the 12 AM to 12:30 opening range gap. So whatever buy entry I get, I'm taking it into that. And much as how we have worked below this 12 AM to 12:30 opening range, I expect it to be traded into and filled, because we have worked below it a lot. And going back into, so today is Tuesday, we had a fair value gap that formed on Monday. So I would want to take price into the daily fair value gap as my target in the premium market. So just like that, expect the market to spike into that at the open, giving me my entry, but this doesn't fail me to exit the trade. If I have taken the whole of this, I cannot fail to take profit because of this small move. Now those are discipline issues. So have the market working in that, and then remember we had a fair value gap that the market respected. So put this off. That would have been your FIP entry. We have that market rally is higher. This is inverse. Now this is an inversion fair value gap right there. Then the market rally is higher, coming back into inversing the first presentation. We'll trade back into consequent encroachment of that. Remember, the market first shows you signature that this has strength in it. So we work into the lower half of that. We fail to go above it. The market rips above that. Then we trade back into that. You would want it to stay in the upper half of it, because we respected the lower half of it, so we do not have any business right there. And we're having a bullish order block right there at the consequent encroachment of that fair value gap. Now the market rally is higher, reclaiming this bullish fair value gap again. Consequent encroachment, the bodies respect a mohawk right there. Then the market rally is higher, disrespecting these levels. So I can use these as inversions again. The market respects that. Then we managed to rip above the 1%, the 1 fib level. So I'm working with this 1 fib level because this is the level I expect the market not to take out if we are in sells. Now if we take it out, then I expect the market to bounce off of that and then we continue higher. We have a week right there. The market respects that. This is it as a gap, and then rallies higher into 12 AM to 12:30 opening range. And note that this reversal comes, if I'm to mark 10 a.m. 10 a.m. opens up. Sorry, I wanted to pull your eyes into Sunday's trading. Sunday's open. So we have Sunday's open marked out. The market closes above it, uses it as a level. If I were to close back below that, you see, market drops into this inversion fair value gap and rallies back above into Sunday's open. Now this shows me that this has formed the low of the week, so I'm expecting this low to stay protected. Now you can look into price for the coming days. I do not expect, at high chances that this low is going to stay protected. So the market rallies back into this Sunday's open, uses it as a significant level, then we rally higher, just like that. I expect the market to come into the daily fair value gap low, and then we see how it reacts going into these highs right here and the quadrants of that daily fair value gap. Okay, until then, therefore guys, we shall meet later. Thank you for watching.